If you have watched or read investment articles before, you must have heard of dividends. So in this video, let's talk what is dividend, how is it calculated, and who can benefit from it.
Hey everyone, welcome back to the Financial Fitness channel. Our channel is all about money and self-development tips. So if you haven't subscribed to us yet, remember to hit that subscribe button down below and let's get this started.
What is dividend? Dividends are cash bonuses given by a company that you've invested in. There are mainly two types of dividend payouts: cash dividends or stock dividends. The difference between these two is that the company either pays the dividend in the form of cash or stocks. Either way, dividends are not guaranteed, nor is the payout amount fixed. Whether or not the company decides to pay dividend or how much they decide to pay, it really depends on the company's decision and also the company's financial performance. But why do companies pay out dividend? The main reason for that is to build confidence to its investors so that the investors will stay invested with the company and also at the same time attract more new investors to invest in the company. When a company has the capability of paying out dividend, it signifies that the company is financially stable and profitable, which is a quality that many investors sought for. Therefore, when more investors invest their money in the company can have more funds to put in their business and make even more money. The companies can pay out in monthly, quarterly, half-yearly or yearly, but monthly dividends are rare. Usually in Malaysia, dividends are paid in quarterly, if not half-yearly basis.
So why dividend stocks? Dividend stocks are quite popular for investors who seek for a source of long-term income. And unlike property, where you'll be taxed for the rental income and capital gain, dividend stocks are not taxable. So that means whatever you earn from the stock, you get to keep it to yourself 100%. On top of that, many investors sought for dividend stocks is also because dividend can help reduce overall portfolio risk and volatility. That means even if the share price falls, as long as you hold on to the share, you can still receive bonuses in the years to come and sell it when the share price finally goes up. And lastly, dividend stocks generally outperform non-paying dividend stocks, and they also tend to strive through even during down market period. There are actually many companies in Malaysia that pays out dividend. All you have to do is Google Dividend Stocks Malaysia and there will be rows and rows of company for you to look at. If you're looking to compare dividend stocks, you can refer to its dividend payout history on the KLSE website to see the consistency and the amount that the company has paid throughout the years. But again, just remember that past history does not determine the future dividend payout or the stock's future performance. So before you invest in any dividend stocks, you must also look into other various factors which we have already covered in this video over here, so you can check it out later. So how is dividend calculated? Usually the companies would declare their dividend either in terms of dividend payout or dividend yield. Dividend payout is calculated based on the amount that the company is willing to pay for every share held by the investor. For example, if the company declared a dividend payout of 18 cents per share and you hold about 50,000 units of share, that means you will get a dividend payout of 50,000 times 18 cents, which is 9,000 ringgit. If the company declared a dividend yield of 3.6% based on the share price of 5 ringgit, basically you take 3.6% times 5 ringgit, you get about 18 cents per unit. So if you hold 50,000 units, again, you get 9,000 ringgit. So as you can see, they are both the same thing. Sometimes you may see it in percentage, sometimes you may see it in cents. It really depends on the person writing it.
So are dividend stocks worth it? Most of the dividend payout stocks are quite pricey. On top of that, if you are planning to make use of the price fluctuations to earn some capital gain, the chances that you can do so with dividend stocks are lesser compared to growth stocks, because the prices for dividend stocks are usually quite stable, which is an advantage and a disadvantage depending on how you see it. Personally, I think it depends on your investment strategy. Generally, the dividend stocks are for the long-term approach, where investors prefer to have their capital preserved and receive dividend as income payouts throughout their investment period, which can also be considered as a lower risk stock investment. But if your aim is to have a high capital gain in a short period of time, then the dividend stocks may not be suitable for you.
On our channel, we always emphasize on balance. So if you're new to stock investing, a good rule of thumb is always to diversify so that you can reduce your risk and grow your wealth in the long term, which is what all of us want.
Again, thank you for watching. If you find this video helpful, then please give it a big thumbs up and subscribe to us for more weekly money education content like this. We'll see you next time. Bye!